Imagine waking up and seeing Ethereum soaring decisively above the $3,600 mark, igniting a wave of excitement across not just the crypto world, but mainstream finance as well. Meanwhile, XRP is shattering resistance barriers with explosive force, leaving previous limits in the dust. The headlines are ablaze with the words, "Bull Run," and the energy is nothing short of euphoric. Social media feeds are flooded with green charts, Wall Street titans are making bold new bets, and even your tech-savvy neighbor is buzzing about the unstoppable momentum of digital assets. But just as the party seems unstoppable, a sudden and ominous shadow falls across the charts. Technical indicators start flashing warning signs. The mood shifts from pure exuberance to a sharp edge of caution. The question arises, is this the start of a historic new leg up for crypto, or the setup for a gut-wrenching reversal? To understand where we are, let's rewind and retrace the wild journey that brought us here. The cryptocurrency market has always been a roller coaster, not for the faint of heart. It started in 2009 with Bitcoin's mysterious genesis, an experiment in digital money that attracted cypherpunks and visionaries. In the early years, only a handful of enthusiasts believed in the dream. Then came the first major bull run, and by 2013, Bitcoin had proven it was more than a passing fad. We saw the rise and fall of Mt. Gox, the boom and bust cycles that would become crypto's trademark. In 2017, the world watched as retail investors, drawn by tales of overnight riches, poured into ICOs and new tokens. The market shot up in spectacular fashion, only to crash just as suddenly, wiping out fortunes and teaching a harsh lesson in volatility. But the innovation did not stop. In 2020, the DeFi summer transformed Ethereum into a financial laboratory, with new protocols promising to replace banks, lenders, and exchanges with code. The following year, non-fungible tokens (NFTs) exploded into mainstream pop culture, turning digital artists and meme creators into millionaires. Crypto was no longer a fringe experiment. It had entered the cultural mainstream. Fast forward to 2024, and the approval of spot Bitcoin ETFs by major United States regulators marked a turning point. Institutional giants, BlackRock, Fidelity, and others were now officially at the table. In July of 2025, BlackRock's IBIT alone led the pack, attracting over $500 million in inflows, while total Bitcoin ETF inflows hit $1.3 billion for the month. The FIT21 Act passed in the United States House, aiming to clarify the regulatory landscape and define the roles of the SEC and CFTC in digital asset oversight. It was a signal. Crypto was being welcomed into the halls of traditional finance. Every historic milestone in crypto's saga has been accompanied by its own blend of risk, opportunity, and raw human emotion. Arthur Hayes, co-founder of BitMEX and a veteran of market cycles, famously said, "A Bitcoin retracement to $70,000 is a normal bull market move, offering a buying opportunity for savvy investors." This wisdom is more relevant than ever, as volatility remains the only constant. Today, technical analysis has become an essential tool for traders of all skill levels. The market is a constantly shifting puzzle, where every candlestick on the chart, every spike in volume, and every reading on the relative strength index tells a story. Traders watch for patterns, symmetrical triangles, falling stars, golden crosses, hoping to read the market's next move. The rise of on-chain analytics has taken things to another level, allowing deep dives into network activity, transactional flows, and investor behavior in real time. But as we zoom in on the present, something different is happening. Over the past 2 weeks, XRP has staged a rally that stands out even among major altcoins. Its price rocketed up to nearly $3.70, before aggressive sellers stepped in and pushed it back down to around $3.49. On the daily charts, analysts have spotted a classic falling star candlestick pattern, a technical formation that often signals an impending reversal after an extended bullish run. This pattern is characterized by a long upper wick, a small real body, and little to no lower shadow. It screams that buyers tried to push higher, only to be met with forceful rejection. The warning signs don't end there. Volume has surged, a telltale sign of speculative frenzy, and the relative strength index for XRP has soared past 88 deep into overbought territory. In simple terms, the asset has overheated, pushed to extremes by a mix of institutional money and retail enthusiasm. According to CoinMarketCap, XRP's weekly trading volume has averaged $2.5 billion, up by 15% compared to the previous week. Institutional participation is growing, with rumors swirling about future ETFs and regulatory breakthroughs. But the technical picture is flashing red. Unless bulls can defend key support levels, a correction may be just around the corner. Let's turn to Ethereum, the digital world's programmable backbone. After a period of tight consolidation between $2,800 and $3,100, Ethereum broke out with force. It surged past the psychological barrier of $3,000, then quickly climbed to $3,600, and even tested resistance at $3,700. The market's optimism is palpable. Ethereum has outperformed not only Bitcoin, but nearly all other major cryptocurrencies over the past month. Institutional inflows are a big part of this story. The rise of Ethereum ETFs has opened the door to traditional investors, and demand is surging from DeFi protocols and Layer 2 solutions. Ethereum's staking ratio soared to nearly 30% in July of 2025, a milestone that signals growing trust in its long-term security. According to DeFi Pulse, Ethereum's decentralized finance protocols now control $47 billion in total value locked, more than double the nearest competitor. Deribit reports that options open interest for Ethereum has hit a record high of $15 billion, reflecting bullish speculation on future price movements. Technical indicators, however, are approaching dangerous territory. The relative strength index sits at around 85, deep in the overbought zone. Some analysts, such as Tom Lee from Fundstrat, are wildly optimistic, predicting that Ethereum's push into real-world asset tokenization could drive the price to $15,000 by year's end. Yet the charts warn of exhaustion. Any dip to the $3,300 to $3,000 range could either be a golden buying window or a bear trap waiting to snap shut on unwary investors. And then there's Bitcoin, the original king of crypto. After surging to a local high of $123,000, Bitcoin is showing signs of fatigue. Its price has slipped back to the $118,000 range, with technical analysts noting a pair of rejection candles near resistance. The relative strength index, while still high at about 68, has cooled from its previous extremes, suggesting that bullish momentum is slowing. Volume data tells a similar story. Recent daily candles show waning demand, and funding rates are cooling, indicating that the speculative fever may be abating. On-chain data reveals even more complexity. Open interest in Bitcoin futures remains near all-time highs, suggesting that leverage in the system is still elevated. If volatility spikes to the downside, this could trigger a cascade of liquidations, flushing out over-leveraged traders. Simon Peters from eToro warns, Bitcoin's long-term outlook is positive, but investors should brace for short-term volatility and pullbacks. Meanwhile, Matthew Sigel at Van Eck remains bullish, forecasting Bitcoin at $180,000 by mid-2025. And Standard Chartered has gone even further, projecting $200,000 by late 2025. Kathy Wood of ARK Invest has even suggested Bitcoin could one day hit $3,800,000, driven by institutional adoption and its role as an inflation hedge. With these dizzying highs and looming risks, investors are left asking a pivotal question. Are we on the verge of a massive shakeout? Or is this just another brief pause before the next wave higher? The answer depends on a complex set of market forces that are about to collide. Let's break down the critical drivers that could shape the near future for Ethereum, XRP, and Bitcoin. First, institutional flows are at an all-time high. The approval of spot ETFs for Bitcoin and the growing likelihood of similar funds for Ethereum, XRP, and even Solana have fundamentally changed the landscape. Bloomberg analysts now peg the odds of XRP and Solana ETF approvals hitting the market by 2026 at 95%, citing regulatory progress and growing demand. If these forecasts hold true, the inflow of capital could be historic, providing a powerful second wind to these digital assets, just as short-term traders prepare for turbulence. Second, regulatory clarity is advancing at a pace never seen before. The FIT21 Act, passed by the United States House in July 2025, aims to finally define the roles of the SEC and CFTC, providing much-needed guidance for the industry. This development, alongside Europe's markets in crypto assets regulation and similar moves in Asia, could invite even more institutional capital by reducing legal uncertainty. As regulation increases, mainstream adoption is likely to accelerate, and digital asset management is projected to become a $2.5 billion market by 2030, growing at a 4% compound annual growth rate from 2024, according to Globe Newswire. Third, technical exhaustion is becoming impossible to ignore. XRP's falling star candlestick pattern, combined with a sky-high relative strength index, is a classic warning sign. If sellers gain the upper hand, a wave of profit-taking could trigger a rapid correction, pushing prices down to the $3.30 or even $3 mark. FX Street analysts have pegged resistance for XRP at $3.85, with support at $3.30. For Ethereum, any drop toward the $3,300 area could attract dip buyers, but also risks a deeper retracement if momentum falters. For Bitcoin, the risk is equally stark. If support between $115,000 and $117,000 breaks, the price could quickly fall toward $110,000, the upper limit of the prior consolidation range. Such a move would likely shake out weak hands, but could also set the stage for the next leg up, as institutional buyers look for value in the dip. Amid these technical warning signs, the broader market remains driven by a mix of macroeconomic factors, ranging from inflation and interest rates to geopolitical turmoil. The global economy faces persistent uncertainty, and crypto is not immune. As Dirk Willer from Citi points out, Bitcoin as digital gold is premature. It lacks the history and stability of traditional safe havens. Events like the Federal Reserve's rate decisions, supply chain disruptions, or even global conflicts can send shockwaves through every corner of the market. Yet, it is crucial to remember that within every crisis lies opportunity. Corrections are not just inevitable, they are healthy. They clear out excess speculation, allow new capital to enter at more reasonable valuations, and reinforce the foundations for the next upward move. Galaxy Digital estimates that investors in the new Ethereum ETFs could earn net yields of around 2% per year after fees, making them attractive even in a cooling market. For patient and disciplined investors, dips to key support levels like $3,300 for Ethereum or $3.30 for XRP could provide rare accumulation opportunities. So what practical steps can you take if you are watching this unfold as an individual investor or crypto enthusiast? Here are some actionable insights to help navigate the volatility. First, don't panic at the sight of red candles. Volatility and corrections are an inescapable part of crypto's DNA. The savviest investors do not chase parabolic green candles. They prepare for volatility and use market swings to their advantage. Establish clear entry and exit points before you trade. Use stop losses to manage risk, and never invest more than you can afford to lose. The key is to remain emotionally detached and stick to your strategy. Second, focus on both the macro picture and the technical details. Markets are driven by narratives as much as by numbers. Track support and resistance levels, such as Ethereum's psychological floor at $3,000, or XRP's critical range between $3.30 and $3.85. Watch on-chain data for early clues of trend reversals. Open interest, trading volume, and net flows can reveal the mood beneath the surface. Stay tuned to regulatory news, because a single bill or ETF approval can change the game overnight. In July 2025, MicroStrategy held over 21,441 Bitcoin, valued at roughly $2.5 billion, underscoring the scale of institutional conviction. Third, diversify your exposure. As Mark Cuban recently put it, crypto is finding its place. Specific chains and applications will emerge as clear winners. Don't concentrate all your holdings in one asset or narrative. Spread risk across major assets like Bitcoin and Ethereum, but also consider exposure to innovative sectors such as DeFi, staking protocols, and real-world asset tokenization. The explosive growth in Ethereum's staking ratio, rising to nearly 30% in July, demonstrates mounting faith in the network's security and long-term prospects. Explore emerging ecosystems, but always do your own research and understand the risks involved. Fourth, keep an eye on the broader innovation landscape. Decentralized finance is revolutionizing traditional banking, while NFTs are redefining ownership and intellectual property. The next breakthrough could come from anywhere: a killer app, a regulatory shift, or even a new technology that unlocks fresh potential, like advances in privacy or scalability. However, remain mindful of risks. Smart contract vulnerabilities, regulatory uncertainty, and the ever-present possibility of black swan events, such as major hacks or geopolitical crises, can change the narrative overnight. In conclusion, the fate of Ethereum, XRP, and Bitcoin hangs in the balance. Will they withstand mounting sell pressure and launch into a new phase of growth, or are we on the edge of a significant reversal? Both scenarios are plausible. If institutional inflows and regulatory tailwinds persist, the rally could resume with renewed vigor. Tom Lee's vision of Ethereum hitting $15,000 and Standard Chartered's $200,000 Bitcoin target are not outlandish in a world where institutional capital is flooding in. But if technical exhaustion takes hold, a sharp correction is just as likely. This would offer disciplined investors another chance to accumulate before the next surge. One thing is certain: this market does not reward the panicked, but the prepared. The headlines may obsess over daily price swings, but the real story is about adoption and integration. In July alone, Bitcoin ETFs attracted $1.3 billion in inflows, a testament to mainstream momentum. Ethereum's DeFi protocols now command $47 billion in locked value, double their nearest competitor. XRP's trading volume has surged by 15% week over week, reflecting deepening liquidity and institutional interest. The crypto asset management market itself is projected to reach $2.5 billion by 2030, and as regulatory clarity spreads, the doors to mainstream finance are opening wider than ever before. BlackRock, Fidelity, MicroStrategy, and other giants are not just dabbling, they are making strategic, long-term bets on the future of digital assets. For those willing to adapt, learn, and stay disciplined, the opportunities are profound. So if you found this breakdown valuable, don't forget to hit that like button and subscribe for more in-depth analysis. Let us know in the comments below. Are you buying the dip, waiting for further clarity, or preparing for the next big move? The next chapter of crypto history is being written right now, and your decisions today could shape your financial future for years to come. Stay sharp, stay informed.